Hi you guys, welcome back to Firefighters Financial Toolbox. My name is Brad, and today we're going to talk about taxable investing. In taxable, first of all, what is a taxable account? A taxable account is anything that gets taxed every year. So that could be anything from your savings account, a money market fund, if you have any money in CDs, or if you have a taxable brokerage account. They grow a little bit slower because you have to pay taxes on them each year. And because of that, it grows slower than your tax advantaged accounts. So there's two types of taxation that we're going to talk about. First type is ordinary income. This is whatever your federal income rate is, you guys. The more money you make, the higher you pay in taxes. And when you pay taxes at ordinary income, you could be at 10%, 12%, 22, 24, 32, 35, or the top step right now is 37%. Now, the other type of taxation is what we call long-term capital gains rates or capital gains taxation. These are lower. So when do you realize a capital gain? What is a capital gain? It's any time you have an investment in a taxable account that you sell. We talked about our ordinary income rate being the current federal tax rate, and here's a breakdown. So let's look at married filing jointly. So the 10% is up to $19,750. 12% goes up to $80,250. 22 is capped at $171,50. 24 goes up to $326,600. 32 goes up to $414,700. 35 goes up to $622,050, and anything above that, you're in the 37% tax bracket. So these are pretty high rates. Now, what falls into this? Any interest that you have. If you have money in a money market, if you have money in an online savings account, or even a CD, you're going to get interest every year. The other thing is if you have short-term capital gains. Anytime you sell a stock and it's a short-term gain, meaning less than 1 year, you're going to pay ordinary income tax. All bond dividend, if it's not a tax-free bond, is considered ordinary income. And ordinary incomes you can have ordinary dividends. We're going to talk about that in a minute. So what is exactly a short-term capital gain? As we said, it's an investment held for less than 1 year. So all you day traders out there are going to get hit with short-term capital gains when you buy and sell stocks on quick. What, on the other hand, is a long-term capital gain? Long-term capital gains rates are 0%, 15%, and the top is 20%. A long-term capital gain is any time you held an investment for more than 1 year. So really 1 year and 1 day. Why is it better? As we said, because it's taxed lower. Okay, now let's talk about qualified dividends. I talked a minute ago about ordinary dividends and qualified dividends. A qualified dividend are better because they get taxed at long-term capital gains rates. But not all dividends are qualified, you guys. First of all, there's two things that make dividends qualified. You have to hold it for at least 60 days prior to the ex-dividend date, within the 121 days around the ex-dividend date. So what that basically means, and I know it's confusing, is if you first buy a company and it has a qualified dividend, if you haven't held it for at least 61 days before the first time they claim that they call for a dividend, it's not going to be qualified. But if you keep holding that, it will become qualified and it will be taxed at a lower rate. Okay, now let's talk about net tax. This is what is otherwise known as the net investment income tax, aka the Obamacare tax. This is an additional 3.8% tax that's added to long-term capital gains and qualified distributions if you make over the maximum amount. And for singles, that's $200,000. And if you're married, that rate goes up to $250,000. And here's a chart with our long-term capital gains rates with the Obamacare tax or the NIT tax added in. So you see that over $200,000 for single, that actually gets taxed at 18.8%. And if you get over $434,550 as a single, you would actually pay 23.8%. But that's surely better than 35%. And for the married folks, it's $250,000 would put you into the 18.8%. and $488,850 would put you into the 23.8%. So let's talk about what are good investments to have in a taxable account, you guys. Well, individual stocks, because you can control when you buy and sell them. ETFs are also, or exchange traded funds, are great options as well, because when they do have turnover in their account, which is very minimal, they do a like-in-kind transfer. So you don't have any capital gains on that until you actually sell your shares. Index funds, index mutual funds are a good option too because of the low turnover rate. Because it follows an index, the index doesn't change very much. And because it doesn't change very much, there's not very much capital gains realized until you sell the shares. The other thing is good is tax-free or municipal bonds. Because they're tax-free, obviously you aren't paying tax on them while you're collecting. So we talked about the good. Let's talk about what are bad investments to have in a taxable account. Well, first of all, taxable bonds. Remember, we talked about any taxable bond or ordinary bond is taxed at ordinary income rates. So we don't realize any capital gains rates on this. Not a good thing to have. The next thing we're talking about is REITs, or master limited partnerships. Okay, REITs are basically companies that buy and sell groups of real estate. Now, because of the way they're taxed by the IRS, they do have to pay out 90% of their growth in dividends. And at the same time, you guys, because of that, they are always taxed as ordinary income. Let's talk about actively managed mutual funds. Why are these not good? Because if it's actively managed, the manager is trying to beat the index. He's trying to get a better return. Because of this, it is taxed at a higher rate. The other thing I want to talk about is cash. You guys, having too much cash in the account is not good. So what are some of the advantages to taxable investing? Well, first of all, you can access your money anytime you need it. So you don't have to wait till you're 59 and a half to take the money out like you would from a Roth or even a 401k. We talked about dividends and how qualified dividends are taxed at a lower rate. Tax loss harvesting. And because of it, you have a greater ability to control the taxes that you have every year. So let's talk about how tax loss harvesting works. Let's say you bought a stock and you bought XYZ and you paid $10,000 for it. And that year the market went down and it dropped to $5,000. Then you turn around and you sell stock XYZ for the $5,000 and you buy a similar stock. Let's say it's another tech stock, WXY, and you pay it $5,000. You actually have a write-off that you can use against other stocks that have appreciated. So how does it work again? Okay, next you sell stock ABC and it has a capital gain of $10,000. Now, because you already had the $5,000 loss from selling XYZ, you're only going to pay capital gains on $5,000. Or let's say you sell ABC and it has a gain of $5,000. You wouldn't owe any taxes at all, you guys. What if you don't have any winners? What if it's a bad year and the market's down? You have no capital gains at all. You can actually offset up to $3,000 of your taxable income, i.e. your wages from a job, up to $3,000 a year. And because you had a $5,000 loss, the remainder is actually going to carry over until you use it, until you have a balance of zero. All right, you guys, these are some of the things that we've talked about that really can help people in their investing journey. I hope you got something out of this. If you did, give me a like. If you're not already subscribed, you guys, hit the button, ring the bell. We'll get notified each time I make a video. We're going to continue with this series on the 3. The next thing we're going to cover is the tax deferred bucket. All right, we'll see.